All right. Good morning, everyone. Thanks for joining us. My name is Peter Arment, Senior Aerospace Defense Analyst here at Baird. We're delighted to have with us Mercury Systems. With us from Mercury, we have Chairman and CEO Bill Ballhaus, and then we have Executive Vice President and Chief Financial Officer Dave Farnsworth. Thank you guys very much for joining us and helping us kick off day two of Global Industrial Conference here. So, Bill, I'll start with you, maybe just from a macro and a demand environment, if we could kick things off. You've spoken recently about a record backlog. You posted a book-to-bill, that was well above 1.2 if you look at just the last 2 quarters combined. Yeah. How would you kind of characterize the demand environment today for Mercury, both maybe domestically and then internationally?
Yeah, thanks, Peter. By the way, thanks for the video. I was a little sluggish in the room before the video. Now I'm kind of pumped up, so good to see.
We do that here.
Yeah, thank you. Thanks. I think there's a lot of conversation about the demand environment right now associated with what I would consider tailwinds in the market, both domestically and globally. Things like Golden Dome, the domestic defense budgets growing toward $1 trillion. More interesting for us, I think, is the allocation of the defense budget, moving more towards the acquisition of capabilities and technology and away from services, and that really plays to our sweet spot. I think there's some interesting priorities in the administration, executive orders like the use of commercial technology. And then, of course, what's happening with Rearm Europe and the tripling of the defense budgets. But before I talk about any of those tailwinds, what's really driving our demand environment in the near term is what we've expected to see for, 2.5 years. And it's kind of a unique phenomenon to what's going on at Mercury right now. This is a company that was largely built through 15 acquisitions over a 10-year period of time. And about five or so years ago, we won a number of really significant development programs. And the way our business model works is we generally go after development programs where we design something new that gets designed into a platform, for example, and then we have long production runs after that where typically the volume is high, the gross margins are good, they're very predictable, and those programs can run for a very long time. So going back to 2.5 years ago, we had a very high mix of development programs that we needed to execute on. And it created some challenges to address dozens of development programs all at the same time. But we knew that as we worked our way through the development programs, we were going to see the production start to kick in, and that's what we're seeing right now. First, it's low-rate production, so we complete a development program, and then you start to develop the first few production units to really prove it out, and then start to ramp up over time. And right now, we're right in the middle of that ramp. And so what's happening is our business is expanding. You talked about our book-to-bill. The last 5 quarters or so, we've been right at double-digit organic growth, right. And that's all associated with this ramp up in production. And we're nowhere near full-rate production across right. Those dozens of programs. That's going to kick in front of us. But the other thing that's significant is massive margin expansion. Last 2 quarters, our EBITDA margins have been right around 17.5%. That's up 700 basis points from where we were a year ago when we were right around 10%. And of course, we see those continuing to rise as we drive toward our target profile, which is like low to mid-20s, and we expect to be there really soon. So a lot of excitement around defense technology in the space generally. I think associated with the broad market tailwinds, those haven't even kicked in for us yet. Right. Really what's happening for us, the growth that we're seeing, the book-to-bill, our record backlog is associated with that transition in our business of a massive amount of development programs we've successfully executed on. And now we're on the other side of it with the production starting to ramp up. That's
a great overview. Maybe just you mentioned Golden Dome, so just maybe could you expand about how Mercury kind of is positioned within the architecture that is obviously yet to be revealed, but General Gutlein will be out here probably by the end of the month or early in December, and how you see that translating maybe into kind of any program opportunities in the next several years.
Yeah, I think it's pretty exciting. I think there's a lot that's still to be defined, but it's moving very quickly. And again, any tailwinds associated with Golden Dome are outside what we've discussed in terms of getting to our target profile of above market growth, low to mid 20% EBITDA margins, and free cash flow conversion of greater than 50%. What I think is exciting about Golden Dome is for us at Mercury, when we think about the potential architectures, they involve multiple layers. There's a space layer, there's an airborne layer, an intercept layer, detection layer, there's a ground layer, there's radar processing, there's subsystems on ships, there's a lot to it. And when I think about the administration's priority of getting capabilities delivered within the next 3 years, that largely has to come from acceleration and increased quantities from existing systems. We participate across all of those layers on existing systems today. So while it's a little bit uncertain in terms of how funding will get allocated and in what order in the timing, we have massive exposure to the potential tailwinds of increased funding across all of those layers. So for Mercury, you know, at the crux of what we do, we deliver mission critical processing at the edge. So you think about high performance compute, storage, signal processing at the edge for defense applications. We're almost ambivalent. The funding can flow to satellites, to aircraft, to radars, et cetera, and then it's going to funnel into the need for processing power at the edge. And we're one of the few players in the world that can do that, deliver performance and security at the same time. So I think it has to play out. I think it is playing out pretty quickly, so there's a little bit of a TBD in terms of timing and where specifically, but we're very optimistic about the potential for those tailwinds to kick in.
Okay, yeah, that's great. And one last over, kind of staying in the demand environment, European defense budgets obviously are starting to just inflect and inflect in a meaningful way. How are you engaging with those customers? And does that, do you expect that percentage of mix to grow over time?
Yeah, I think that this is also very exciting for Mercury. Our international business, which primarily is Europe and direct with European primes and FMS, is roughly, 16%?
Yeah.
16% of our portfolio. In the trailing 12 months, our growth rate has been about 15% for our international business. And I think that reflects our positioning, the relevance of our technologies around mission-critical processing at the edge. It also reflects the fact that we've got very focused channels to market that are direct with the European primes and with the domestic primes through FMS. So we, again, have very broad exposure to what's happening there, and we're seeing effectively a tripling of the European defense budgets, growing from about $300 billion to $1 trillion, so on par with the domestic defense budget. Very similar to what's happening domestically, where we are in conversations right now with all of our primes around the potential for increased quantities, accelerations across dozens of programs. I mean,
Right.
It's not concentrated or isolated on our portfolio. It's across numerous programs. It's the same thing in Europe. And the primes are asking us, can you deliver faster? Can you deliver more? And it's in critical areas which would make sense based on anybody's understanding of what's happening in Ukraine around missile defense and EW and radar processing, which again is right in our wheelhouse. So we're seeing really good growth in our international business, but before those tailwinds kicking in, and we're pretty excited about our exposure there too.
They wanted a lot of indigenous kind of capabilities over there. Is that come up at all, or is that how do you think about that? Is it more teaming? I guess?
think we have to see how that plays out, how that dynamic plays out. We're a little bit of Mercury inside. So we're
Okay.
the processing power that's in the guts of these systems. And so, so far we've just seen the increase in demand. We've seen the European primes want more and want faster and not look for alternatives. And very candidly, there aren't many alternatives for what we do.
Got it. Perfect. All right, let's move over to kind of like...
It is, Peter, but I would
Yeah.
say, to Bill's point, both in Europe and in the U.S., it's more of existing technology. It's
Right.
not, hey, go develop something for the next 3 years and then we're going to deploy it. It's, hey, we want more of these things you're already doing. We have a base of 300 or more programs. So it's across that whole program set. They're looking and saying, can you do more of those? Can you double that? Can you, how much faster can you get it to us? So.
And it makes the journey that we've just been through on the development programs even more interesting, because we've gone through a multi-year journey of slogging through dozens of development programs, completing those, sitting here now with the latest technology that we're accelerating our rate of deployment.
Yeah.
So it's a pretty exciting time.
That's terrific. Super good demand tailwinds. But let's move over to kind of the ramping production and kind of operational execution. You mentioned on the last call, performance excellence, accelerating kind of the deliveries. You've been reducing adverse EACs by 50%. Maybe you could talk a little about what are the core elements that have enabled that improvement, and how repeatable is it across other programs?
Yeah, well, there's a couple things going on there. One is, I think it's just a reflection of how we're executing on development programs, the fact that we've got the bulk of this wave completed and behind us. But also, when you go through a journey like we've gone through over the last few years, you get better.
Yeah.
So we've matured in how, critical functions like program management, system engineering, operations, supply chain, we have been relentless in driving performance improvement in those areas. I mean, it looks like, 125 straight Mondays where we're with the teams grinding through this stuff to get to the other side. So you're naturally going to get better. That's on the development side. So we've seen the impact of EAC adjustments, and if we won't get into the accounting of it, but in this industry on our programs, if you're wrong in your estimate of what it takes to get something done, you can see a lot of volatility in quarters tied to cum catch-ups on EAC adjustments. Those are way down, and it's a reflection of the maturity and then the progression. But the other thing that we mentioned in the call is the acceleration of deliveries into the quarter.
Right.
We're in a position where we've got a record backlog, and it's growing every quarter, record backlog, and we're accelerating deliveries as we're trying to ramp up on these production programs and keep pulling things to the left. So in the last quarter, our margins were above our expectations. They were, just under 16%. We were thinking they're going to be more in the, low double-digit range, closer to 10%. But it was driven by accelerations of deliveries that pretty much just flow through a gross margin to the bottom line because we're keeping our OpEx in a really tight box. So that acceleration is just a waypoint for us that shows we're ramping up on production across these development programs, but we're also preparing for these tailwinds for accelerations on programs pretty much across our portfolio.
Yeah. So speaking of preparing, you're expanding your manufacturing footprint in Phoenix. I think adding some automation, over 50,000 square feet. That's going to come on later this fiscal year, I guess, towards the end. How's that investment change when you think about when demand kind of starts to build?
Yeah, we're in a really interesting spot when it comes to the demand or the potential demand and how we might scale. And right now, we're looking across like the top 12 to 15 programs where we see the potential for tailwinds, and we're trying to get ahead of what might the constraints look like. And in general, what we see based on pretty massive potential increases in quantities, a very incremental investment profile in order for us to scale up and not needing to scale up ahead of the demand certainty, seeing the demand certainty and then scaling up. And for the most part, we're at one shift across our operations and our factories. So the easiest thing we can do is go to, multiple shifts. The one area where we felt like we wanted to have a larger footprint was in Phoenix, where we have a highly automated manufacturing facility in Phoenix. And you can imagine for a company that's been built up of 15 acquisitions over a 10-year period of time, we don't look like what you would design from a clean sheet of paper, but we are moving towards what you would design from a clean sheet of paper, and largely that looks like a small number of larger scalable manufacturing centers, and that's Phoenix. So this was the one area where we felt like if we were to add some square footage, then we could get out of some subscale facilities and concentrate our production there, which would put us in a better position to scale efficiently. And of course, all those numbers are in our run rate, in our cost structure. So everything in front of us, we feel like is very incremental in terms of what we would need to do to scale up to capture those tailwinds.
Got it. Great overview. When you talk about ramp to rate, maybe could you talk a little bit, what does that success look like maybe on a program by program basis?
Well, I think it's a matter of just working through the constraints on each of them. So if you think about the general journey of going through development and then low rate production and then scaling up to higher volumes, it generally looks like proving out the design, proving out the manufacturing process, and then aligning the supply chain. And so much of what we do is automated that it really comes down to getting the supply chain aligned, getting material staged in on time, and then driving it through the automated process.
Got it. You mentioned margins earlier, so let's talk a little bit about that. Adjusted EBIT margins, they expanded by more than 500 basis points year over year to, like you said, 15.8%. Dave, maybe you want to jump in here. What's the biggest drivers behind you think that expansion? And then I'll ask a follow-up to that.
Well, certainly getting, the development activities behind us. One of the things is, we have a strong focus on the margin that we're putting into our backlog and the margin that's going out of our backlog. And, we've been working diligently on finishing the programs, the older programs that have lower margin in them. So there's just a natural rise to the margin as you complete those. And the programs we've been adding into our backlog are at what we expect the margin to be in order to achieve our outlook for the long term. So, we're watching the margin in backlog. We're doing everything we can to finish as early as possible those things that have low margin. We're not booking new low margin activities. And, a lot of that consequence of we're moving into the production phase on a lot of these activities. So a lot of the bookings you've seen for us reflect new production bookings. So, that at the same time, and Bill mentioned, we're really keeping we've restructured the company in a way to ensure that there's not duplication of effort across organizations. We created a single operations organization where we used to have multiple operations organizations. Same for engineering. We had engineering being done 15 different ways at 15 different places, and now we have one single organization. And we've been able to grow, as Bill said, we're 10% growth, for the last 6 months over the 6 months a year ago without any op expense. So, we've got it in the box. We've got it where we need it to be. We feel like we can scale up our volume without increasing our op expense at that kind of ratio. So it's really those two things that are driving the margin. And it really is a question. It's just execute.
Right. So you mentioned the lower margin mix, and I know that that's kind of still flowing through in this upcoming quarter that we're going through right now.
Yep.
But how long should we kind of think about that lingering, as we think about that?
You want me to take it?
Yeah.
Yeah, I'd say sometime over the next, 4 to 6 quarters, we should see most of that flush through. And this is an important point to understanding our value creation proposition going forward. In the near term, it's really coming from two things. It's the ramp up in the top line tied to the ramp up in our production programs. And then it's the big step up in our margin expansion that's tied to this conversion of our backlog, the low margin stuff burning down and getting replaced with high margin production backlog. It's not like we have a part of our business that's low margin and we're trying to reposition it and grow it to higher margins.
Right.
It's a distribution of programs, and the legacy development programs that we took EAC adjustments on now sit in that low margin part of our distribution, and we're just finishing those. So that part of our backlog is disappearing, and it's getting replaced with higher margin production. As Dave said, 700-ish basis points of margin expansion over the last year. It's not tied to magic. It's just this backlog lift, and then the positive operating leverage that we're getting from getting our OpEx in a really tight box and the volume ramping up.
Yeah, and part of that also is you mentioned the 80-20, the 80% kind of production-oriented, 20% kind of development mix, and kind of that's, I think, your ideal target. Kind of where are we in that evolution today, and then, how do you think about sustaining that?
Yeah, and just to put a fine point on it, what we said 2 years ago is that we are running at a very high mix of development programs, roughly 40-60 development to production, when nominally we've run closer to 80-20. And so we've been expecting, as we execute on development programs and brought in production bookings, that we would move more towards our traditional mix. We've said that our bookings over the last year plus have been aligned with moving us to that 80-20 production mix, and I think our margin expansion shows how we've been moving in that direction. But, Dave and I have talked about this. It's not clear that we want to be at an 80-20 mix, because the larger percentage of development that we have, as long as we don't have so many programs in the riskiest phase all at once like we had 2 years ago, the development programs are a great thing. They're a leading indicator of future organic growth tied to the production, and our maturity in executing the development programs is off the charts compared to where it was. So we've talked about moving toward 80/20, but I could see us lifting off of that and being okay. And we've had some really exciting development wins recently that, 3 years from now are going to turn into the next set of production programs that are ramping up.
And that target EBITDA margin profile is still kind of that mid-20 kind of goal, right?
Yeah, low to mid-20s. That's what we're focused on right now. And again, that's before any of the tailwinds.
Tailwinds kick in, yeah.
And if we get, we've looked at it. If a couple of the dozen plus that we see potential kick in, it could be a significant increase in our top line growth, and then we would expect to see pretty significant positive operating leverage come with that, because our OpEx, as we've said, in a tight box, and we don't see it coming up dramatically.
Let's move over to Dave's favorite subject, cash.
He loves cash.
He loves cash, I know. So free cash flow improved by $16 million year over year. You've reduced net working capital by over $100 million. What are the next levels to kind of, Dave, to think about reaching the long-term target of 50% free cash flow conversion?
Yeah, it's a continuation.
To EBITDA conversion, yeah.
It's a continuation, where we continue to focus on, the best use of the balance sheet we've got. We were in a situation in the past where, Mercury was using its balance sheet to fund the primes. That just doesn't make sense. And so we've changed the contracts we have going forward. The new ones we've entered into in the past 2.5 years or so all have better payment terms for Mercury, where we're not using our balance sheet. We've gone out and worked with the primes in many cases, and one of the things that we've been successful in is getting cash ahead of when we're buying some of this material. So we've got the cash on our balance sheet. We've reduced our net working capital by $200 million in the past 2 years, which is, a phenomenal exercise for us. We have a ways to go.
Right.
We're just under 50% net working capital of trailing 12 months revenue. We think we can get closer to 35% over time, which will free up additional cash.
And part of that was unbilled, which I used to beat you guys up about. But
it is unbilled.
We've been working on that.
We were working on it yesterday with one of our customers.
But I think, at the end of the day, free cash flow, the trailing 12 months, our free cash flow has been north of $130 million.
Yeah.
So I think that's the evidence that we understand what we need to do. We're working it. We're making a ton of progress. But not where we want to be. We still have work ahead of us.
Yeah, so the cash generation is inflecting. And so you recently announced a $200 million share repurchase. Obviously, I think that gives a lot of confidence in what you think the cash generation is going to be. But so why was that the right time to add that?
Well, obviously we're in a different place today than we were 2 years ago with the net working capital, the free cash flow that we generated. We've been focused on delevering. We've gotten to what we think is a very comfortable place. And the reality is we want to have all the tools in the toolkit available to us to drive long-term shareholder value. We are very consistent, though. Our primary focus is the organic value creation opportunity in front of us. What we see in terms of the top-line growth potential, the margin expansion that we've got very clear line of sight on, the flow-through free cash flow, we are not going to get distracted from, delivering on that. And our approach so far has been focus on that and just delever. We have $300 million plus of cash in the bank. We've been very deliberate with how we've allocated our cash, and we'll continue to be deliberate. We just wanted to have all the levers available to us.
And you just recently did something with the revolving credit facility, right?
Yeah, we extended the revolver out for 5 years. So, good, solid terms for us. So, not something we need to worry about in the near term. And we feel good about where we are.
Let's move over to sort of some of the innovation areas that you've kind of talked about. A lot of us we're trying to understand what the CPA is, the Common Processing Architecture program is. Where does production stand today, and how do you see that driving kind of the bookings momentum? Because I think a lot of us didn't understand what a critical kind of innovation this was.
Yeah, and this was the source of a lot of our development challenges going back a couple years ago. We have a common architecture that supports numerous development programs that are ramping up into production. Maybe to talk a little bit about what the Common Processing Architecture is. In general, for this part of our business, we deliver very secure, high-performing servers to the edge for defense applications across all domains: space, air, land, sea, et cetera. And the crux of our value proposition in this area is we make the latest commercial technology. So think about high-performance compute processors, data storage, and high-performance input-output. We package that up in a way that's accessible for defense applications. So we deal with very intense size, weight, and power requirements. And then uniquely, we provide security requirements that nobody else can meet, such that should that equipment get in the hands of adversaries, the IP is protected. And I'll leave it at that. So we had a number of technical challenges that we needed to work our way through so that we could deliver those products at scale and high yields. And the short story is that's all behind us.
Right.
We addressed those issues that we talked about in FY24. We've been ramping up, and as we've expected, the bookings and the increased production volumes have been coming. And that's a big growth area for us, and it's an area where we think we've got pretty good exposure to some of these tailwinds.
And standing out, I think, versus peers, right?
100%.
Yeah. And I think just one of the other things is you also there was a Star Lab acquisition was part of a piece of this. Could you explain that piece? Because I know the cybersecurity part of this is a big deal, or security in general.
I don't have to elaborate on it with this group. It's hugely important. Cybersecurity is important to all of us. It's important to our warfighters on platforms at the edge. It couldn't be more important anywhere else. The way that we provide security is multidisciplinary. So there's a number of different ways, from the physical instantiation of the product, sensing that we have around it, signal processing, and then cybersecurity software that we have running on the product that protect the system during boot time, during runtime, et cetera. And with that acquisition, we basically added to our software stack in the boot time and the runtime protection. And so our customers had been going to Star Lab and integrating that into our products. And by taking on this acquisition, which is pretty incremental for us, but has a lot of value because now it's seamless for our customers, it's frictionless for them, it's accretive to our gross margins, and it's been really successful.
Awesome. All right, so we only have a couple minutes left, so let's talk a little bit about maybe the long-term outlook and just an investment thesis in general, because things are you're at a kind of an inflection point in general. So you've delivered really 2 strong quarters of book-to-bill above 1. You've expanded margins. You've seen positive free cash flow. How should investors think about the pace of the convergence to your target model and the milestones that you kind of signaling, that you track?
Yeah, we haven't given a specific timing,
right?
But just think about the velocity. We were at 10% EBITDA margins in Q1. The last 2 quarters, we've averaged 17.4% EBITDA margin. So you can see the velocity and the trajectory as the backlog margin is improving, and we're starting to get positive operating leverage. We've also, we've been growing at 10%. So I think those 2 dynamics together paint a pretty good picture of how we're converging. I think as we get through this fiscal year, we'll have a much better idea of how the low margin has actually burned down. And then it's just math to be able to predict when we think we'll get into that target zone.
So when you look back,
we'll get there. We're very confident.
And so when you think about 3 years forward, the low margin mix is kind of out. And it looks like you have a much more sustained performance. So confidence around that.
Yeah. No, super confident about it. And actually, that picture 3 years out, I think that's what motivated us 2 years ago, was to get to that place. And I think the layers of the cake that I see is, first, we will be operating at our target profile, and will have been operating at our target profile for some period of time. We may see some of the tailwinds from Golden Dome, domestic priorities, European budgets start to kick in. And I think that could be really exciting. I mean, we should start to get visibility into that over the next couple quarters in bookings, and then the bookings will translate. So our target profile, potential upside tied to the tailwinds. Right now, we're winning new designs on new platforms that will start to ramp up in that period of time. It's maybe a little bit hidden, but every time we deliver one of those servers that I mentioned earlier, there's a built-in refresh cycle, because the second we deliver it, there's more advanced commercial technology that's available, and many of the platforms that our servers sit on are going to want a built-out in a new server and the latest technology in the next spin. And then if we just think about where defense is going and the need for high performance processing at the edge, and we think about how AI and machine learning start to get proliferated at the edge, I see us being a provider, not just of mission critical processing at the edge, but AI compute engines that are proliferated throughout the network and enabling that software to run. So, I mean, that's kind of the cake that we see in front of us, and we're really excited about it.
Yeah, it's a terrific overview. And thank you so much. We're out of time. Bill and Dave, thank you so much for
Thank you.
supporting the
Appreciate
conference.
it.
Appreciate it.
Thank
Thanks,
you.
Dave.
Thanks.
Thank you, everyone.